Welcome to the deep dive. We take your sources, transform them into clear, actionable insights.
That's right.
Today, we're plunging into the latest financials from Tapestry Inc., the house behind Coach and Kate Spade. We've got the Q4 and full year 2025 earnings call, investor decks, press releases.
All the good stuff.
Our mission: unpack these fast, focus on earnings, guidance, and what it really means for Tapestry going forward.
Let's do it.
Okay, let's dive straight in. Tapestry just dropped its Q4 2025 results. On the surface, looked like stronger than expected numbers. So what did this last quarter actually look like, financially speaking?
Well, what's fascinating here is how Tapestry really did surpass expectations. Quite significantly, actually.
Okay.
Their earnings per share, the EPS, hit $1.04. The forecast was $1, so that's a solid 4% beat.
Nice.
And revenue also came in higher, $1.72 billion against an expected $1.67 billion.
Yeah.
And that represented an 8% jump in revenue on a constant currency basis year over year.
That constant currency piece is always important, isn't it? Takes out the exchange rate noise.
Exactly. Gives you a clearer view of the underlying business performance.
Yeah.
And get this, they also hit a record gross margin, 76.3% in Q4.
Wow.
Yeah, up 140 basis points year over year. That's, 1.4 percentage points. Shows they're making more profit on each sale.
So clear wins on revenue and earnings for the quarter. But you know how the market is, always looking ahead, looking at the bigger picture. How did the full fiscal year stack up? Did that momentum carry through?
It did, and quite impressively. For the full fiscal year, Tapestry didn't just meet expectations. They actually hit these bold targets they set 3 years back.
Oh, interesting. What were those?
Well, they reported $7 billion in revenue, which is a solid 5% increase year over year. And maybe even more telling, their adjusted EPS, earnings adjusted for unusual items, jumped 19% to $5.10.
So they broke that $5 barrier they were aiming for?
Precisely. Hitting over $5 in earnings and returning over $3 billion cumulatively to shareholders, that shows real follow-through on their long-term plan. And it speaks to their financial discipline. Plus, you add in 17 straight years of dividend payments, aggressive share buybacks. Investing Pro actually gives them a good overall rating because of this consistency.
Okay, now here's where it gets kind of weird. Despite all these strong numbers, the beats, hitting targets, Tapestry stock took a pretty big hit.
Yeah.
It feels counterintuitive. How do we square that circle? What's going on there?
It really does raise that question, doesn't it? You see good news, you expect a good reaction.
Exactly.
But the stock dropped almost 15% in pre-market trading. Fell to around $96.59 from over $113.
Ouch.
So it suggests investors are looking past the rearview mirror, right? They're focused on what's coming down the road. Some analysis indicates the stock might have been trading above its, quote, fair value already.
Meaning it was maybe a bit overpriced based on fundamentals?
Potentially. And its beta is 1.53.
Okay, what does that mean in simple terms?
It basically means the stock is more volatile than the overall market. So for every 1% the market moves, Tapestry tends to move about 1.53%. Higher beta means bigger swings.
Got it.
So any hint of future trouble, like these tariff concerns we'll get into, or competitive pressures, it can trigger a sharper drop, even if the current results look good. The market's clearly worried about something.
Okay, that market reaction really sets the stage then. If the past was strong but the market's nervous, what are they anticipating for fiscal 2026? Let's unpack that forward guidance.
Right. So looking ahead, Tapestry sees revenue getting close to $7.2 billion. That's mid-single-digit growth, pro forma.
Okay.
And they expect EPS between $5.30 and $5.45. So it's about 4-7% growth. But, and this is a big but, this guidance includes some pretty significant headwinds they're preparing for.
Headwinds, yeah, that word popped up a lot in the sources. Tariffs seem to be the big one. Can you break down that impact? How bad is it, and what are they doing about it?
Absolutely. Tariffs and duties are the main drag. They're estimating a hit of about $160 million.
Wow, that's substantial.
It is. It represents roughly 230 basis points of pressure on their margins. A big piece of this is the end of something called de minimis exemptions happening sooner than expected.
De minimis. Remind me what that is.
Sure. It basically allowed companies to ship goods, like e-commerce orders, into the U.S., duty-free up to a certain value threshold. With that ending, more of their imports, especially online, will face taxes. It directly hits their costs.
Okay, so a direct hit to the bottom line from policy changes. How do they fight back?
They're not just sitting there. They expect to mitigate about 30% of the annualized impact, which they estimate at $235 million run rate over time.
Ow.
by leveraging their supply chain, making it more agile, and optimizing where they manufacture globally.
Yeah.
But yeah, it's still a material challenge they have to navigate.
So with that tariff pressure, what does it actually mean for their margins, their profitability next year?
Well, it's a mixed bag. Operationally, from the core business, they expect gross margin to actually expand by 120 basis points.
Okay, that's good.
But then the tariffs come in and basically wipe that out, and then some, leading to an overall gross margin decline of about 70 basis points for the full year. Now, that's partly offset by a 60 basis point tailwind because they sold Stuart Weitzman, which had lower margins.
Right. We'll touch on that sale.
But what's really interesting is how they plan to still grow operating margin overall. Despite the gross margin pressure, they're aiming for operating margin expansion
How do they pull that off?
through tight cost control. They're targeting at least 100 basis points of what's called SG&A expense leverage, basically getting more efficient with their selling, general, and admin costs, making each dollar spent there work harder.
Even while increasing marketing spend.
Exactly. Even as they plan to bump marketing spend to over 11% of revenue, which is a significant investment in brand building.
Yeah.
So it's about being smarter with other costs.
And what about right now, the first quarter of fiscal 26? How are things looking immediately?
Q1 seems to have started strong, actually. They mentioned accelerating revenue trends at Coach.
Okay.
So they're forecasting a low double-digit total sales gain for Q1, and they expect EPS to grow by more than 20%, hitting around $1.25.
So a strong start, even with the full year tariff cloud looming.
Yeah, suggests the underlying business, particularly Coach, has momentum, even if the full year picture is more complex due to those external factors.
Okay, let's talk about those brands, because Tapestry isn't just one thing, right? It's Coach, Kate Spade. Let's start with Coach. It sounds like they're really carrying the water here. What's their story?
Oh, absolutely. Coach had, frankly, an exceptional year, their strongest ever. Full year revenue up 10%, and Q4 was up 13% on that constant currency basis.
Wow, where is that growth coming from?
It's broad-based, which is encouraging. North America up 16%, China up 22%, Europe up 12%. Real strength across key markets.
Impressive.
But here's the really compelling part, I think, is who they're attracting. They brought in 4.6 million new Coach customers in North America this year alone.
4.6 million, that's huge.
It is, and nearly 70% of them are Gen Z and millennials.
Okay, so they're cracking the code with younger consumers.
Totally. And these younger customers aren't just browsing. They're spending more per item, higher average unit retail or AUR, and they're sticking around, better retention rates.
What products are clicking?
Iconic stuff like the Tabby bags, the new New York family,
Yeah.
but also niche things. They mentioned a Kiss Lock bag selling out in hours. That signals real brand heat, you know?
Definitely. And they're doing this while being less promotional.
Yes. Growing both the average price and the number of units sold with less discounting. That's the sweet spot for a healthy brand. Real demand.
Okay, so Coach is firing on all cylinders. What about Kate Spade? The sources made it sound like it's, well, in a different place.
That's a good way to put it. Kate Spade is definitely in the early innings of a turnaround effort.
The numbers reflect that.
They do. Q4 revenue was down 13%, full year down 10%. They're calling fiscal 26 a year of investment for Kate Spade, so they expect continued pressure on revenue and profit there.
So what's the plan? Are they using the Coach playbook?
To some extent, yes. Applying lessons learned, focusing hard on building brand awareness, and bringing in new customers. They did a spring campaign with Ice Spice and Charli D'Amelio, targeting that Gen Z audience.
Did it work?
They said initial engagement was positive, so early signs. They're also doing some structural work, streamlining the handbag assortment by over 30%.
Why?
To focus on fewer, bigger ideas, make the core offering stronger and more relevant. Some newer collections like Deco and Kayla are apparently doing well with younger buyers at higher prices.
Yep.
So similar strategy to Coach, just earlier stage.
Got it. A work in progress. And the third brand, Stuart Weitzman. What's happening there?
Stuart Weitzman is, well, it's no longer part of Tapestry. They completed the sale to Claire's on August 4th.
Ah, okay, so they divested it. Why?
It aligns with their strategy. They talk about being diligent stewards of their portfolio, disciplined capital allocators, basically focusing resources on the brands Coach and Kate Spade, where they see the best growth potential.
Does that sale impact the financials much for FY26?
They said the impact on operating profit and EPS is expected to be immaterial. So it cleans up the portfolio, lets them focus.
That makes sense. This focus on capital allocation brings up their overall financial strategy. Beyond the brands, how are they showing commitment to shareholders and keeping the balance sheet healthy, especially with these investments in headwinds?
Their financial health looks really solid, and shareholder returns are clearly a priority. Fiscal 2025, they returned $2.3 billion to shareholders.
How much of that was buybacks?
A big chunk included a $2 billion accelerated share repurchase, or ASR program. That's a fast way to buy back a lot of stock.
And looking ahead to fiscal 26.
More returns planned. The board just approved a 14% hike in the quarterly dividend. The annual rate should be around $1.60 per share.
That's a decent yield increase.
It is. And they plan to buy back another $800 million in stock.
So dividends and buybacks continuing. What about debt?
Their balance sheet looks strong. About $1.1 billion in cash and investments. Net debt, so total debt minus cash, is pretty low at $1.3 billion. Their leverage ratio is 1.4 times, well below their target range.
Healthy.
Very healthy. And their adjusted free cash flow last year was $1.35 billion. That's a lot of cash generated to fund investments, dividends, buybacks, everything.
Okay, so wrapping this all up, what's the big picture takeaway for you, the listener? It seems like Tapestry is showing real resilience, hitting targets, but also facing real challenges, especially tariffs.
Absolutely. They've shown impressive strategic agility, exceeding goals while navigating this tricky environment. The investments in brands, especially connecting Coach with younger consumers, are clearly working.
Yeah.
Kate Spade is the one to watch as they execute that turnaround plan.
Right.
The overall story is a company with strong fundamentals, a clear plan focused on direct customer connections and product innovation, and importantly, they're being upfront about the headwinds like tariffs. That ability to adapt and deliver even when things get complicated globally, that's really the core of this deep dive.
Yeah, that transparency is key. So here's a final thought for you to chew on. Tapestry is betting on both digital and physical stores. They want to grow their store footprint while deeply engaging Gen Z and millennials online and off. In a world facing ongoing economic shifts and trade uncertainties, how might the specific blend, this sort of phygital luxury approach, actually redefine how high-end brands connect with customers and thrive in the future?